equity markets rallied during quiet August trading, with several indices hitting new highs. Meanwhile, equity market volatility remained largely unchanged and around historical averages, consistent with a market with one eye on passing peak growth and another on the rising potential impact of the Delta variant. Large cap growth outperformed. Tech performed strongly, as did financials, and in particular banks. Emerging markets modestly outperformed developed markets as Chinese equity markets stabilized following July's volatility. In government bond markets, US yields rose very modestly, with the yield curve flattening as 5 sold off more than 30s. In European bond markets, German bonds also sold off, with the 10-year yield rising around 8 basis points. The US dollar rallied modestly versus other G10 currencies on higher rate expectations. Against slightly higher rates, higher yielding credit outperformed as risk appetites favored spread products. Emerging market, external debt, and local currency debt indices both posted positive returns, while EMFX broadly rallied. While Chinese markets stabilized, in Brazil both equities and bonds sold off, given political turmoil and continued COVID-19 concerns. Commodities indices were led lower by a weaker oil price, as WTI futures dropped from $74 to a mid-month low of around $62 before rallying into month-end.
As the US and Europe return from summer holidays, tapering discussions now seem squarely in market participants' crosshairs. The Jackson Hole speech by Chair Powell was broadly well received by the market, with both equities and bonds rallying. The speech appeared to confirm that a tapering announcement should be expected this year, consensus being that November's FOMC meeting is the most likely. But Chair Powell continued to emphasize that the path to the first rate hike would continue to be driven by the employment picture. In this context, the US has continued to make progress, but unemployment remains elevated relative to pre-COVID levels, and labor participation is still lagging despite unemployment benefits now having largely expired. In early September, the jobs data confirmed that the employment market still had ways to go, with fairly weak payroll data for August after a strong showing in July. Markets will now focus on the upcoming September FOMC meeting, particularly as there is no meeting in October. On the other side of the Atlantic, European PMIs in August came in weaker than July data, which had been on 15-year highs. What did increase was inflation, which led to fairly sharp upward movements in yields for many European markets. Markets will closely follow if tapering is mentioned in the upcoming ECB meeting. Outside of the US and Europe, many international investors continued to focus on China as they tried to evaluate the potential impact of President Xi's common prosperity, as well as the implications for impacted sectors and for overseas listings of Chinese equities. Markets stabilized, helped by positive local news flow from the Chinese regulators. However, significant uncertainty remains. Lastly, concerning COVID, cases had soared throughout the summer, but started to plateau in later parts of August. As the colder months in the Northern Hemisphere are approaching, there's increased discussion about booster shots and extending vaccination to teenagers and children. While weaker Asian PMI data was likely driven by increased restrictions in recent weeks, Europe and the US are trying to learn to live with the virus, with growing vaccination requirements necessary to participate in activities such as indoor dining and other social events.
Our broad outlook is largely unchanged from before the summer break. We believe it's prudent to remain positioned to benefit from continued economic growth and modestly higher rates, while retaining diversification against any setback or disappointment versus expectations. Despite having increased equity allocations in July, we retain some headroom to add further should there be market volatility. The known tail risks for the market, i.e. those widely debated by market commentators, strategists and clients, seem to continue to be an unruly taper or a sustained inflation shock. The degree to which these are widely debated suggests that a large portion of this could well be in the price. For example, thinking about tapering, it's worth reminding ourselves that in 2013, both the background fundamentals and the catalyst for the tantrum were different. Emerging market bonds, in particular, had rallied strongly into 2013 and were arguably looking expensive before selling off. Meanwhile, the announcement of the reduction in Fed purchases came not from a telegraphed tapering statement or strategy, but from Chairman Bernanke's Q&A before Congress.